Have you ever found yourself sitting at the kitchen table, staring at your budget, and wondering what on earth you should actually do with that little bit of extra cash at the end of the month? It's a question that sparks literally endless debates online. Welcome to Dollar Playbook, I'm Taylor Reed. Today, we're going to break down this classic dilemma in this explainer. We're cutting through the noise and diving straight into the real, grounded math of paying off your debt early versus investing.
Okay, let's hit the stage. Imagine you've got your basic life expenses covered. The rent is paid, groceries are bought, and you have exactly $600 left over every single month. What's the move here? Do you aggressively attack your debt to get it out of your life for good, or do you put that $600 into the stock market to let it grow? Everyone seems to have a really strong opinion on this, right? But we're going to look at the cold, hard numbers.
To make this perfectly fair, let's look at two identical guys, Jake and Marcus. They're both 28 years old, and they both make $55,000 a year. They're starting at the exact same baseline, carrying $42,000 in average consumer debt. So that's $22,000 in student loans at 5.5%, a $14,000 car loan at 7%, and a $6,000 credit card balance at a pretty steep 22% interest rate. And of course, they each have that $600 monthly surplus to work with.
Section 1. The 2-year checkpoint.
So they take completely different paths with their extra cash. Jake? He sacrifices his lifestyle to relentlessly hammer away at his debt. He's using the debt snowball method, attacking the smallest balance first, which is the credit card, and putting every single extra dollar toward it. Marcus, on the other hand, takes the path of the internet finance gurus. He makes only his minimum debt payments and invests his entire $600 into a low-cost S&P 500 index fund, which historically returns about 10% a year. Marcus figures, why pay off cheap debt when you can earn more in the market? Fast forward 2 years, and Marcus looks like a spreadsheet genius. Thanks to compound growth, his portfolio is sitting at roughly $16,000. Now his net worth is negative $18,000, which actually puts him slightly ahead of Jake's net worth of negative $19,000. Jake has absolutely $0 invested, but he's wrestled his debt down to $19,000. So on paper, Marcus is winning by about $1,000, and he got there while still, going out to restaurants and living a pretty normal life.
Section 2. The spreadsheet illusion.
If we stopped the explainer right there, Marcus would be our champion. But let's uncover why this early lead is actually just a mathematical illusion. This brilliantly highlights the flaw in Marcus's strategy. He's earning roughly 10% in the stock market, sure, but he is simultaneously paying 22% on his credit card. Every single month that he invests, instead of paying off that card, he's effectively subsidizing the credit card company with $110 in interest. That is guaranteed money flying straight out of his pocket to a lender, no matter what the stock market does.
And it gets worse when you look at the whole picture. Marcus has a blended debt interest rate of about 9 to 10% across his loans and credit card. But once you account for the taxes he has to pay on his investment gains, because this is just a normal brokerage account, his real after-tax return is closer to 7 or 8%. The spread between what Marcus earns and what his debt actually costs him is razor-thin across the board, and it's deeply negative when you look at that credit card.
Now, to be completely fair, there is one specific place where Marcus is mathematically spot on. If his employer offers a 401k match, let's say a 50% match on his contributions, that is an instant 50% return on his money. That beats paying down any debt at any interest rate. The match is literally free money. But remember, Marcus isn't just capturing the match here. He's investing his entire surplus while still carrying massive high-interest debt.
Section 3. The 10-year scoreboard.
So, what happens when we pull back the lens and look at how these two completely different strategies play out over an entire decade? Well, Jake, our debt payer, sprints to the finish line. He completely eliminates all $42,000 of his debt in just 34 months. Boom, gone. Suddenly, he has absolutely zero minimum payments dragging him down. He takes a few months to build up a solid 6-month emergency fund, and then, from month 41 onward, he redirects a massive $1,400 a month entirely into investments. His original $600 surplus is now combined with the $850 he used to waste on minimum payments.
Meanwhile, Marcus is just stuck on the minimum payment treadmill. Because most of his minimum payments go straight to interest, he slowly pays off his obligations over 8 agonizing years. His credit card takes over 3 years, his car takes 5, his student loans take 8. He gradually increases his investment contributions as those debts finally fall away, but man, he is dragging a heavy anchor that whole time.
By the end of year 10, the scoreboard completely flips. Jake, who didn't invest a single dime for the first 3 years, totally overtakes Marcus in total wealth. Jake reaches a portfolio of up to $175,000 compared to Marcus's $155,000. Think about that. Jake invested for less than 7 years, while Marcus invested for a full 10, yet Jake comes out significantly ahead.
So, why does Jake actually win? First off, he stopped funding lenders. By killing his debt in under 3 years, Jake saved between $12,000 and $18,000 in pure interest. Second, his monthly investment amount was significantly larger. $1,400 compounds incredibly fast once you're completely free. And finally, during the most financially vulnerable years of his life, Jake never had to make an emotional decision about a stock portfolio during a market downturn.
Section 4. The behavioral reality.
Now, there is a massive behavioral assumption hiding in Marcus's supposedly optimal plan that we really need to address honestly. Every calculation we just showed you assumed Marcus was a flawless investor. But a famous JP Morgan study tracking real investors over a 20-year period revealed a pretty stark reality. While the market returned about 10% annually, the average human investor earned roughly 3%. Not 10, not 8, 3%.
Why the massive gap? Because human beings panic sell when the news gets scary. They pull out cash for sudden car repairs. They stop investing during market crashes. Spreadsheets expect you to be a flawless robot for 10 straight years. But Marcus is a human being. He's got a car payment, a credit card balance, and a stock portfolio that will absolutely eventually drop 25% in a single quarter. Jake's plan works perfectly because he can't panic sell a portfolio he doesn't own while he's paying off debt. His principal debt reduction is a guaranteed return, whether the market is up 20% or down 30%.
Section 5. Making your choice. Here at Dollar Playbook, we want to give you a reliable framework for your own life, so you can build a stable financial foundation. So here's your game plan. Step 1. Always capture the 401k match. Free money is mathematically unbeatable. Step 2. If you have debt above 8%, like credit cards, absolutely destroy it immediately. Step 3. If your debt is below 5%, the math does safely support investing your extra cash. And Step 4. If you fall in that 5 to 7% gray zone, your choice depends entirely on your own discipline, your tax bracket, and your ability to stay the course without flinching.
You know, the real trap isn't just choosing between paying off debt or investing. The trap is making a huge life decision based on some half-understood rule of thumb, without honestly assessing your own habits. At the end of the day, the best financial plan isn't the one that wins on a spreadsheet. It's the one you'll actually finish.
So, I want to leave you with one final question to think about. If you decided to keep a loan around just to invest the difference, would you actually set up the automatic transfers, invest the money, and never touch it for 10 years? Or would you just spend it? Be honest with yourself about your own discipline. If you found this explainer helpful, please like, share, and subscribe to Dollar Playbook as we continue building stable, stress-free financial lives together. Thanks for tuning in, everyone, and I'll see you next time.